Hi, I'm Lindsay Bell with Global Markets Intelligence at S&P Capital IQ. We are in early innings of the first quarter earnings season. S&P 500 growth is currently pegged at negative 3.3% on earnings per share of $26.70, a relatively low bar in our opinion. Analysts got comfortable with a contraction of 3.1 to 3.3% in early February, despite oil prices that remained erratic and a continued rise in the U.S. dollar. This week, it was all about the banks. Goldman Sachs and JP Morgan were standout reporters as volatility in currency trading helped to drive outside growth in their trading businesses. And investment banking fees reached new highs on the heels of increased M&A activity. Looking at the sector overall, loan growth has been mixed, with some strength in commercial loans and some weakness in consumer lending. The major negative in the quarter has been the further decline in net interest margins. Both regional and money center banks had net interest margins decline slightly more than we expected in the first quarter. An improving interest rate environment will be necessary for the banks to see advances in this area, but many banks don't expect the Fed to increase rates until later this year. Encouragingly, many CEOs provided positive commentary regarding their business and the direction of the economy. Financial sector earnings estimates are beginning to move upward. Growth bottomed earlier this week at 10.6% before bank results were released and now stand at 11.1%. Banks continue to be a key contributor for the sector with growth of 26.7%, followed by REITs with 15.3% growth. As a key indicator of the economic environment, we will keep a close eye on the sector as earnings season unfolds. Next week, we get into peak earnings season with 147 companies set to report results. That should start to give us a good feel for the health of corporate America in the first quarter. Until next time, I'm Lindsay Bell with S&P Capital IQ.